Hi everybody and welcome back to the Online Lending Technology Think Tank. For those of you who've just joined us, you just missed a really good session on lending futures. That will be available online after this event for you to tune in and have a look at that and see what you missed. But that was really good. It provided us with a real good intro into this section, which we're going to be looking at credit risk strategies. But before I go into that, I just want to, for new people who've just joined us, I want you to just have a look at the panel that you the dashboard that you can see in front of you. On the left-hand side, it's got information on the agenda. It's also got information on our speakers, also some information on our sponsor, who is Data for this session. So have a look at that as well. It's got some really good information on there, and also some information on our next session sponsor, who are Credit Kudos in the open banking section. So I'd recommend you have a look at that. There's also an interesting section called resources, and in there you can have a look and download information while you're looking at this event or post-event as well. It's available on the platform afterwards. So that's good. We hope you all want to have a look at that. But also want to point to you as well, the important part on that section is our questions section. It's a conversation icon. If you can have a look at that and ask any questions as they pop up throughout the event, that'd be fantastic. We'll put them to our panel and in particular our chair, and he will run through that and see if we can get an answer for you. If we can't, we'll try and come back to you after the event in our review and cover that with our review on the Credit Connect website. Also, throughout, we'd really like you to participate in our event polls. They're totally anonymous, so we won't be following up on the information you give us for that, but we want to create a real body of work around lending and the industry generally that we can share with you moving into the future. So please have a look at that. So, right, let's move on to this session. Enough from me. We're going to be looking at credit risk strategies, and I'm going to now hand over to our event chair, Chris Warburton, who will introduce our panel for the event. Chris, over to you.
Thanks, Colin. So this session here, session 2, we're going to talk about credit risk. And a little bit around what the environment's changed, and really it's a forward-looking view. Before we start, maybe just a little bit of introduction by way of introduction for myself. So those who weren't on the last call, my name is Chris Warburton. I'm going to be the chair of this event. A little bit of my background. So I spent what will be nearly like 30 years in really sort of risk operations, looking after running, I suppose, helping with process transformation, really across the customer life cycle from front-end collection, front-end lending, so front-end lending through fraud, and then some of the back-end credit collections as well. Currently director for Irish strategy, and we'll be doing a series of videos really exploring some of the latest ideas and technology in this kind of space, so it fits in really well. So that's a little bit about me. I say this session here, we're going to talk about credit risk. We've got a really great panel. So we've got Eleimon Gonis, who's a senior risk manager for stress testing modelling methodology oversight at Nationwide. We've got Michael Hoare, who's chief credit officer for RateSetter, and Stephen Brown, who's the head of intermediaries at Scottish Building Society as well. So I don't know if each of you guys just want to give a very sort of brief introduction around maybe what you do and where you come from. Eleimon, do you want to go first? Top of my screen.
Yeah, I'll try to keep it very brief. As a matter of fact, as of yesterday, I'm no longer Oversight. I'm no longer responsible for oversight of stress testing, but I'm responsible for, and I tried very hard to come up with a title for myself, and the best I could do is emerging financial risks, because I'm now focusing a lot more on climate change, climate risk, financial crime, which is not emerging. I think it's well established, but equally, this is an area that we take an active interest in, and other things like valuation and valuation resolution. So as part of the resolvability of financial institutions, and predominantly the reason why I'm here in my capacity, machine learning, artificial intelligence, and the future of lending. Very briefly, I've been in my past life, what seems to be past life, I've been an academic researching credit risk. And I've also worked briefly for the Prudential Regulation Authority, regulating the banking system in the UK.
Okay, great. Michael, brief introduction.
Sure, thanks. Yeah, my name is Michael Hoare. I'm the Chief Credit Officer for RateSetter. I've had 17 years in financial services across 3 different companies. Previously, I've worked at Capital One and PayPal. so across consumer lending, cards, loans, but also SME lending as well, and always with a focus on credit and fraud strategy and analysis. And RateSetter has recently, 6-7 months ago, been acquired by Metro Bank. So I've spent the last sort of 4 years in a peer-to-peer lending setting, which is a little bit different, but now moved into, I guess, what we call challenger bank. So I haven't worked in one of the big retail banks, but I've seen a number of the sort of different challengers and sort of medium-sized businesses.
Okay, great. And Stephen, last.
Sure, yep. So my name's Stephen Brown. I'm Head of Intermediary Lending for the Scottish Building Society, one of the smaller societies in the UK. So we date back to 1848, and we've been around for a very long time. I started my career around 20 years ago, so I tend to date people within our industry under the regulators, which they have worked with or under. So I predate regulation. I go all the way back to the MCCB, or the Mortgage Code Compliance Board. So I don't know if that makes me a dinosaur or not, but I've been around for a while. I started my first small mortgage brokerage in the early 2000s, and then went on to work with one of the largest brokers in the country in a senior leadership role. And then I moved over to Clydesdale Bank to work in intermediary distribution for a decade. And I started with the Scottish just over a year ago. So I think I had 3 weeks in the office before COVID hit. And then, yeah, it's been an interesting year since.
Fantastic. So see, we got a great bunch of people, and I suppose, yeah, the focus of this session is specifically on credit risk, and particularly, where do we go from here going forward? So we want to try and have a bit of a future looking view if we can. I mean, but we can't do that without almost like taking a step back and just really recognizing what's happened over the last 12 months with COVID. And I suppose where we sit now, I mean, the economy appears sort of really uncertain. I mean, do we need to factor that into our credit risk assessments as we go forward? I mean, how do you think it's changed, and what do we think we need to do from a credit risk point of view, sort of going forward? I mean, Stephen, do you want to just take that?
Sure, I think you're right. I think the economy is very uncertain. I think in many ways highly polarized. So I think if we look at the economic impact of COVID, it is asymmetrical. So there are some areas of the economy that are flourishing, others are floundering. Money that would usually have been spent on holidays and socializing and mobility and transportation has been funneled into other things, and sort of property, garden furniture, things like that. So industries that are typically strong performers are struggling, whilst actually on the flip side, we've seen artificially high levels of profit in other areas. So there's sort of two sides of a very real credit risk coin there that needs consideration. I think what I would say about our approach has been not to apply a one-size-fits-all strategy. So we can do this because we're a small lender and not all lenders can, but we haven't at any point during the pandemic applied a blanket policy throughout COVID. So we are still very much assessing each case on its own merits. Every customer has a story. We listen carefully. We then look to shape a solution for that individual. But I think, harking back to my earlier point, it's super important that we remain vigilant. And there are businesses that have profits that are booming just now that may not last. There are businesses that are emerging from survival days, and we may not just simply they may not just simply return to profit immediately. I dug out. There's an article which I dug out, it was published quite a while ago in 2009 by the European Journal of Social Psychology, and it says that it takes about 18 to 254 days for a person to form a new habit. But the study also concluded that on average it takes 66 days for a new behaviour to become automatic or ingrained. So I think if you think about it, we've been living with COVID now for over a year, and there are a lot of new habits that have been formed. And I think it would be quixotic of us to assume that we're just going to return to the normal of 2019 when COVID finally disappears. Yeah.
There's also a question around whether it's going to finish. So it started almost like with a bang, and it's probably going to finish. It feels like it's more and more looking like it's going to finish with a bit of a fizzle, right? So it's not like it's going to just suddenly stop and we'll be back to 2019. It feels like it's sort of like it's going to change really. And I suppose just on that, I mean, Michael's asked a question just in terms of, I mean, given that's the scenario, do we need to factor that into our credit risk assessment? I mean, how do you sort of think about it in terms of what change do we need to make going forward from a lending and from a credit risk assessment point of view? Any thoughts on that?
I think one of the key things that we're focused on, and it could be a cliff, whereas everything else I think is sort of slowly fizzling out. It could be a cliff, is the end of the furlough scheme. That will be a key sort of watershed moment to understand how much of the pressure the government has sort of kept at bay. So when that is removed, will there be a tidal wave of unemployment because it has all been held back by government support? Or has the government done the right thing in slowly but giving people and companies the time to be able to adapt? That could all fizzle out as well, but there's also a scenario in which case all the companies could just suddenly announce, well, thanks for keeping them employed, but sorry.
And how do you think that will link through to either demand for credit, and then the ability, and I suppose the risk profile to then be able to approve credit or generate lending from a risk appetite point of view?
Well, it depends on the lender's viewpoint of what the probabilities of each of those are, right? It depends if they desperately need to lend and they want to lend, right? You could say, well, that is a downside risk that I'm willing to accept and keep lending through this. Or you could say, well, I don't really need to, so why don't I wait till October and find out which of those it is, and then I can go through the gears. Each lender will be in its own different situation in terms of funding and P&L position, and will be making their own choices.
Okay, and then from almost like from an acquisition point, do you think there's almost like pent up demand, or do you think? I mean, how do you feel about that in terms of what the outlook's like for the next sort of 6 months?
I think there is plenty of demand out there at the moment. It is subdued, but there is demand out there, and because I think, as was mentioned before, people have switched their spending from X to Y, right? So there's been, just walking down where I live, there are more people doing home improvements, there are more extensions going up, but less holidays, right? So people need to borrow for those things. So there's always been demand there. One of the asymmetries, though, has been who has been impacted by this pandemic so far, and it is overwhelmingly the young. Youth, well, under 24 employment, I can call that youth, has surged massively, whereas it hasn't impacted that sort of middle age bracket where a lot of your certainly unsecured lending comes from. Will that still be the case after September, or in the future? That's uncertain, but there's plenty of demand out there, and certainly in the spaces where traditional lenders would be lending.
And what about the impact, I suppose, the payment holidays that came through? I mean, that's affected people, and it's affected, I suppose, affected people's, economically, but also affected some of the data we record as well. I mean, how are you thinking that in terms of impacting credit risk assessments, particularly on the lending piece? I mean, is that going to have an impact? And then you just talk a little bit about, but there could be even like further changes as we come out. I mean, it could revert to sort of almost like a different norm.
I think behaviours will have changed. I suspect that. I mean, so many millions of people have now had a payment holiday, whereas it would have been a fraction of that in the past. Has it become a new normal where people will expect it, right? Because they can turn around and say to their bank, well, you gave me a holiday during 2020. Why can't you give me one for now while I've been made redundant, right? What's the difference? So I think there will be a change in consumer attitudes in the same way as we saw when IVAs were introduced a number of years ago. That changed consumer attitudes towards taking on debt and then potential routes to manage it.
Yeah. And I suppose, Eleimon, to bring you in a little bit around some of the modelling impacts on that as well. So, I mean, what have you seen in terms of like model impacts from COVID, and sort of like, I mean, we were chatting earlier and you talked about almost like this has been like a giant stress test scenario to a certain extent. But I mean, maybe just talk through some of the model impacts and how you sort of see that evolving going forward.
Yeah, I think it's been a stress in the economy, certainly. I think the Bank of England appreciated that, and therefore, and that's the reason why they didn't ask, for financial institutions to carry out the 2020 CST and concurrent stress test, because I think it was clear that the economy was going through a turmoil for whatever reason. The one thing I believe might harbour some extra risk, but I think I'll agree with Michael in saying, it depends how then individual lenders approach this, is the fact that the payment holidays scheme certainly, very much supported by the regulator, has brought about, I might want to call them data distortions, but they have been data distortions for the right reasons. There is, however, something to be said about the almost like the effect of those data distortions on models. As we went through the bulk of the crisis, and as Michael already and Stephen said, as we will start exiting, so to speak, this and returning to some kind of normalcy. My experience of this whole journey through COVID has been that models have been affected across institutions, and the way that financial institutions have responded to it has varied greatly. I know of evidence in Southeast Asia and the USA where lenders went fully radical and redeveloped models to try and follow, let's say, this trend, as it were, to maybe the more subdued European, let's call it, reaction to try and apply some overlays. So I think what we've seen is quite a bit of variability, if you want it, in how financial institutions approach that. Certainly, I would say closer to home, there was what became very important overnight was correct monitoring of models. And therefore, the rapid, how can I say, the rapid response to any model discrepancies or model inaccuracies that were observed.
And what about IFRS 9 models? Is that the economic models? Do you think that's because there are a lot of reserves that were put in? I mean, some sort of like eye-watering numbers that were put in, earlier or late last year or last year. I mean, do you think there's opportunity there in terms of like, did they overpredict or underpredict? I mean, any thoughts on that or?
Well, the one thing I can certainly say is that, and I know that this is no secret whatsoever, is that the payment holidays scheme, etc., brought about a considerable increase in provisions for financial institutions. I think a number of financial institutions have been hit by that in terms of profits, in terms of the bottom line, and overnight, I think, I can't remember which consultancy, but there was a consultancy that was producing some kind of results. They found that there was something between 25 to 40% increase of provisions. It just so happened that it hit a lot of financial institutions at year end as well, so they reported considerably lower profits. Has it got an impact in modeling? Of course it has. I think the models are coming through predicting something that is quite different to the actuals, if you wanted. Now, this is going back to, and I don't want to get into a lot of the technical detail, but this is going back to what I call the data distortions. It really depends on how data are being captured and are then being utilized in the models. And I'll give you just one short example in that I think there's been, I want to call it a gentleman's agreement, but I think it's been an industry agreement that those people that were going on payment holidays, ordinarily, if they went on a payment holiday, they would have some marker, let's just say, on the credit report showing up. But all the reporting agencies in the UK, I'm pretty sure that there was an alliance and an agreement, decided not to put that marker. So this example of data distortion, I think, feeds through, and it remains to be seen what will be the impact of that.
I think that's really sorry, I was going to say, I think that's really interesting because there's a big difference between someone who's taken a 3-month payment holiday and someone who's taken a 6-month payment holiday. So the canary in the coal mine really is the 6-month payment holiday, and I think it could be that to be forewarned is to be forearmed. So there are we had about 12% of our mortgage populace chose to take advantage of the 3-month payment holiday, but that reduced by several orders of magnitude when it came to the 6-month. So actually, it could be that the modelling, and I'm not an expert in modelling, but if you remodeled within the first 3 months, you'd probably have had an artificial view of what your broader mortgage populace was actually thinking.
There's a big difference. Yeah. Sorry, I was going to say there's a big difference in when those people took the payment holidays as well, as to did they need it? Had they actually experienced a financial shock to their system? And so as we've tracked the exits from payment deferrals, we've seen hugely different performance depending on when they went in. So if they went in on almost the day that it was announced versus 6 weeks later, 8 weeks later, they perform very, very differently. And that talks to had they actually experienced a financial shock to their system. And so it's going to be key when we're modeling this stuff in the near future. We're rebuilding our acquisition, our customer management models to differentiate between, as you say, Stephen, the length of time they spent in there, but also when they went in and when they came out, because you've got very, very different experiences.
So do you think there's scope to get additional data? I mean, you're talking about gathering, almost like using the data in a slightly different way to then really understand that. I mean, is there scope to get extra data? I mean, all the digital stuff that's coming through, is that going forward? I know we talked about it on the last call, but do you sort of see that to try and get greater clarity around what the potential risk is, and that calculation to clarify the models?
I mean, additional data, for example, if you got hold of their open banking, if you got hold of all their bank statements, you'd be able to understand it to a greater extent what was going on in their financial life that you wouldn't be able to get from the traditional bureau data, because we made a conscious decision not to allow this to affect the bureau data. Now, it did. You can tell to a certain extent what happened, right? There are ways of doing it. But if you look at their current account, you will get a much better understanding of, did they lose their job? Did they suffer a drop in income, et cetera, et cetera? You'll get a richer picture.
Can I echo that? Can I just say, and I fully agree with Michael and Stephen, and I would say that a lot more financial institutions, and I don't know whether I'm right politically in saying so, I think have beefed up during COVID-19, this period, have beefed up their analytics capability. And by that, I mean that they've tried to look at places where they might not have necessarily looked at before, to try and get these differentiators. As an example, I know that there's been a huge improvement in mining transactional data to try and address some of these concerns. And I fully agree with Michael and Stephen. I think the way forward is not necessarily, ripping an old model apart, throwing it to the trash and starting anew. A lot of that is just supporting an existing model with that level of analytical insight, if you wanted. And I fully echo what Stephen was saying about the percentages at Scottish Building Societies. We've seen something very similar nationwide. We've seen very different percentages of people riding the wave, so to speak, because people felt, oh, it's a payment holiday, it's a payment deferral, I'll take it regardless of whether I need it or not, versus it is something that really affects me, and therefore I need to use it as a tool to avoid financial vulnerability.
I think as well, you've got different kinds of employment type now, effectively, or employment status. So I'm okay being pretty open about this, but we're talking with a CRA, well-known CRA, about actually gathering data direct from employers regards wage slips. So what you're doing is you're setting up a chain of custody with regard to wage slip. It's tamper-proof. You obviously need to secure the customer's consent to be able to get that information, but that would give you the customer's employment status. So are they on furlough, flexi furlough? Has there been some change? Because these didn't exist 12 or 18 months ago. So you're actually then able to gather real-time information in terms of where that customer is at. And what you can actually do as well is pass that through a sector filter. So you can actually look at emerging risks within that sector as well. So whether it's hospitality, which may be certain areas of hospitality that's struggling, then you can get an additional layer of comfort from that data rather than just gathering a traditional wage slip. So it's about the data and potentially where you gather that. And again, I'm straying into areas here that I'm certainly not an expert on, but that's something that as a smaller business that you might immediately think for the Scottish Building Society that might be unaffordable for us, but actually it's not. These are things that the CRAs are prepared to work with even smaller lenders to support.
So it sounds like there's, so the gathering of the data and then sort of the investment in some of the analytics to either maybe not rebuild the models, but as much as nuance the models to then work out how that then aligns against the risk appetite is where people are going. And just picking up your point around investment in data science and investment in analytics, I mean, if it seems like that's been that's sort of been in train, and there's also to a certain extent you see some sort of like centralization of some of those resources as well. I mean, is that kind of a trend? I mean, is there, particularly sort of coming from a credit risk point of view, is we, by centralizing it, is that causing an issue potentially, or we just need the horsepower as we sort of sit today? Eleimon, I know we chatted a little bit about that before in terms of like, how that works, and particularly in terms of like from a data science point of view and specialist credit risk knowledge.
Yeah, I was about to repeat the same comment. I believe that innovation needs to happen. Okay, and I know that one of the things that I've found very hard to come to terms with, making the transition from academia to industry, was that everyone kept saying about this extra 1% in Gini. This extra 1% in Gini might translate into thousands, millions of extra revenue, etc. Now, and I think that there's always this hunt for this extra performance, for this better insight that one can get from a model. My only point there, and it's not concern, I think it's more of an observation, is that you will always need financial organizations will always need people with a subject matter expertise. I think data scientists are incredibly intelligent people. They're incredibly technical and well versed in the computer science, sometimes in statistics, econometrics, etc. But at the same time, depending on the operational model that the financial institution has to deploy data science, they might not be subject matter experts. And there are a number of anecdotal evidence about models built by credit risk models built by data scientists that have left very fundamental variables out of these models. As an example, loan to value in a mortgage model. Now, I might be making it a bit more extreme, but I really want to impress people on that subject matter expertise, on the smooth collaboration between the people who are building the models, who are turning the handle, so to speak, working with the people that have this deep expertise in that.
And Michael, I was going to ask you just to maybe just comment, but also there's a question that came through around just more generally around job opportunities in sort of the credit risk kind of world. I mean, how do you sort of feel about the market or see the market?
Generally, credit risk does pretty well out of downturns. Suddenly, people who say, well, I invested in marketing during the benign period, suddenly go, well, maybe I need more credit risk, maybe I need more data science stuff. So I would say, the whole jobs market froze up during last summer and into early autumn, but then it opened up. I think there are plenty of opportunities out there at a certain level, probably not at the graduate level. I still think that's quite hard because people want to get people who come in and hit the ground running. The other thing I'd say is 100% back up what Eleimon just said. I don't use sort of names because I'm sort of pointing fingers, but you take a PhD data scientist from Facebook or Google and put them in lending. I'd take someone who has a master's who's worked in lending for the last 10 years every day of the week because of that domain experience, the understanding of the pitfalls and lending. Not that lending and credit risk is particularly hard, but like any sphere, it contains its own nuances that it takes you a year, 2 years, 3 years to understand. And I've seen a centralized data scientist sit in technology who was building models on credit risk that made some fundamental mistakes, right? That it was quite hard to find them, if I'm perfectly honest, because they're sat in a different team. It's quite hard to get into the nitty-gritty of what they're doing. But once you do, you kind of look, well, if you've worked in lending for 2-3 years, you'd never have done that.
Yeah. I'm sure it's music to the ears to lots of the credit risk folks sitting on the call, no doubt. So we talk a bit about new techniques and investments in data science. I mean, what are some of the new techniques that are coming up? So machine learning's been quite a big has been quite a lot of discussion around that. I mean, what are some of the new techniques you think are out there, and so how can we apply those with the extra data as we go into the future?
Can I give you my answer very quickly? I know that a lot of people might disagree with me. I don't like the term machine learning. I think I think it's all statistical learning. I think, and that might be quite a big distinction, because a lot of these techniques need to be well grounded in statistical and mathematical theory. Okay, I'm not a mathematician, and I don't purport of understanding a lot of these algorithms to the nth degree, but I believe I have a very good working understanding of a lot of those. I think certainly there is the arsenal of the new algorithms, the newer algorithms that are out there. There's also the benefit of having computational power at your fingertips, in which case, there are solutions out there. And I was shown one very recently where you can run 20 or 25 machine learning models by just hitting a button and not having to worry about anything, coding it yourself or whatever. So I think the first thing is certainly the availability of new techniques, the availability of algorithms. We've always been hearing about how XGBoost, and apologies if people are not aware of this, but these stochastic gradient boosting methods are always outperforming the workhorse of the industry in logistic regression. So you see that on the one hand, but then you see other people, and again, I'm very biased in terms of my academic background. You see a lot of academic studies saying, well, the gains are minimal. The gains are minimal from using, a newer technique versus an older technique. Now, I'm not arguing that should stop innovation from happening, but I think there needs to be a balance in the understanding of what technique fits what problem, so to speak. The second thing is certainly the environment. Now, I want to call it the environment as in the technological solution. It would be fair to say, and again, I don't know if I'm breaking any political correctness rules or whatever, that the workhorse in the financial industry has been SaaS. Okay, a lot of banks have been using SaaS. I'm not arguing that they're moving away from SaaS, but I am arguing that they are a lot more financial institutions are turning towards the open source solutions of R, of Python, because there are other benefits to be had by using them as well.
It's very easy now to download a library of these different algorithms, as everyone says, in R and Python, and try them out. So previously, if you were sat in a data science team, you'd probably do the research about one of these techniques and fully understand it, and then say, right, I'll try that on my next model build. You don't have to do it that way around anymore. You can take pretty much the same data set and then say, I'm going to try support vector machines, gradient boosted machines, ridge regression, etc. That's the approach we've taken. Try them out, see what they do, see what the uplift is. And then afterwards say, okay, well, I see a little bit of a gain here. It's not as much as you might think. Do I then want to spend the time in digging into the academics behind it and understand what it's doing? Because as a credit risk person, you never want to put something in place that you don't fully understand, but you just do it the other way around.
I mean, it kind of links back into your whole piece around having skilled people looking at the output and understanding the output and being able to interpret the output, as much as just physically being able to run it. It's also around having the smarts around and the process understanding, the expertise around it, it sounds like.
Absolutely, yeah. It's just you can do it in a slightly different order, but you never. And I don't like the term machine learning as well. It smacks of the autonomous cars, where the car and the algorithm is constantly learning how to handle this new situation it's seen. That's not what credit risk models are doing, right? You can have an element of the machine iterating itself during the grounding phase, but I would argue we're a long way off having a sort of self-constantly optimizing credit risk model. That's not going to happen, not for a while. We'll probably get there, but no one's going to want to have a sort of a Skynet approach sat in production that you can't, you don't know what it's doing on any one particular day.
I was going to bring in the whole topic around transparency of decision making, and some of the ethics that's sort of going on in the background as well. Do you think that's the controlling factor?
Not first and foremost, although if I want to be political, then yes, it's about ethics and it's about discrimination. For me, the first and foremost is, can I control the credit risk? If I don't know what my acquisition model or my customer management model is doing, because it's going off down its own little tangent, I'm not performing my key role, which is managing credit risk. So no, actually, it's more about credit risk for me than it is about the ethics.
Okay. So as we sort of like look going forward, I suppose, you know, what do you think the big if you go to put predictions, I suppose, in terms of like how you sort of see credit risk sort of evolving over the next sort of like 1 year, 2 years, 3 years? I mean, what are your sort of like top 5 or top 2 or 3? Stephen, do you want to give your thoughts in terms of things we got to watch out for, or new technology as well?
Yeah, I mean, I think in the credit risk space, I mean, so I'll kind of revert back to my area of specialism, which is the humble mortgage. So if we sort of look at the mortgage as a form of asset class, or even just something as simple as money, I think it was someone far smarter than me that said money is just really a database for labour allocation. So I think on this basis, I can't ever see there being a time where we don't have some kind of financial instrument like a mortgage to facilitate home ownership. How we'll weigh that credit risk, how we will fund the mortgage, where the funding comes from, and that entire process end to end, I think will fundamentally change over the next 10 years. It's not a level playing field, and I think the interesting thing when I was listening to Eleimon and Michael talk there is that I think the customers probably don't fundamentally understand what's being used behind the scenes to weigh the credit risk. And the thing that I probably fear most is risk-based pricing. So when you start to put customers into cohorts, if you're a type A customer, how did you arrive at being a type A? You're probably not that bothered because you're quite happy and you're eligible for the best possible rates. But if you're a type C customer, how did you arrive at that? You know, where did the data come from to arrive at the categorization of type C? And then you need to look at the broader market that you actually exist within. And there's a degree of simplification there. So I think a broad ecosystem probably represents quite a fair and balanced market. And I think if we sort of go down this route without putting in, and again, both Michael and Eleimon have sort of alluded to this, without having quite a principle-based approach in terms of the way that we do it, then I think we're embarking on possibly quite dangerous and shaky territory. So I think from a distribution perspective, which is my area of expertise, I think this, as far as the mortgage is concerned, this is the last decade that we'll do the mortgage in the way that we've had. There's a brute force attack on it at the moment from the fintech community for all the right reasons to improve that process. I think a lot of the changes in that sense will probably come from out with the bank and the building society sector, and will probably come from fintechs who choose to, you know, who banks and building societies choose to bring in to support their ambitions.
Okay, and Michael, what's your kind of views on sort of like what the future is going to bring for us in terms of new techniques, new tools, or other things that we've really got to think about?
More open banking, more alternative data sources. It will become key. I mean, the traditional approach is you need to have a good integration with your bureau, making sure that's stable. And then you can make decisions, right? That's not enough anymore. You've got to be taking on alternative data sources, open banking, but there are also there's plenty of other ones, psychometric profiling, et cetera, That's going to become, I think, more mainstream. And routes to market, certainly in unsecured lending, routes to market. It's no longer enough just to have it on your website. You've got to have integrations with your aggregators. The buy now, pay later guys are showing that it's important to have integrations with merchants as well. The pandemic has pushed internet sales up through the roof. They're now snatching market share because they are front and center in online merchants. You're going to see some of the non-buy now, pay later, I think, move into that sphere because there's a big opportunity there. And then if you go way out, when I was sort of thinking about this question, I think someone's going to eventually start lending in cryptocurrency, aren't they? Someone's going to want to be the first, and there's going to be a big fanfare, and everyone's going to go, what? But that's coming.
Yeah. Eleimon, what do you think?
I agree with everything that Stephen and Michael said, and I might be repeating, but I very quickly jotted down the 5 things that I personally believe are of the future. I think data in all its forms. We're talking about alternative data very quickly. You've got social credit scores in China. You've got the European Union actually coming out, I think, recently saying that they're thinking of banning initiatives like this, at least in Europe. So I'm talking about data, the forms of data, both new structured data, unstructured data. I think we're seeing quite a lot of utilization of textual data for credit risk purposes, and not in the very narrow sense of acquisition, but also in the more wide sense of managing your credit portfolio. I'm talking about financial vulnerability, et cetera, et cetera. The second thing is, and that has always been, in my opinion, something that the financial institutions have been trying to do, the kind of modeling and trying to incorporate what I call the exogenous drivers, so effectively the macroeconomic effects, to get more of a real-time view of how the economy impacts on the models. And to that, something very interesting that I need to add, maybe for the modeling geeks, what does that mean in terms of model uncertainty? Because we need to get to the point where we need to start quantifying model error or model uncertainty. The third one, I will slightly disagree with Michael, because I think maybe I've got a vested interest. I think transparency, explainability, and ethics are going to be key. We've already seen a number of less successful attempts at building models, machine learning models, where they had inherent biases, where they were discriminating against women, they were discriminating against race, etc., etc. So I think this, if anything, if it starts creeping into the area of credit risk, we will get to see a lot more emphasis and a lot more focus placed on this area. The third, I think the fourth thing is technology. So the environment that things are being developed in, as well as, I think, as Michael said, the interaction and the talking of systems to each other, as I like to call it. And the fifth, because I've been an academic and I'm a huge proponent of lifelong learning, is reskilling. Being in credit risk is excellent, and someone who has 20 years of deep matter and domain expertise is excellent. But at the same time, I think they will need to keep up with times. They will need to keep up with the evolving nature and landscape of credit risk.
As will the regulator.
As well, absolutely, Stephen. Yes, absolutely.
So we're almost at time, and I'm just going to answer just a couple of questions, if we can. What do you think the due diligence parameters for credit risk will be moving forward? And there's also one there around breathing space, which I don't think we covered as well, whether that'll impact credit risk going forward as well. I don't know if any of you guys want to take any of those. Do you think breathing space will have an impact on, as that rolls out? It's May the 4th, I think it is.
I would say, I mean, just from, as I said, I might be repeating myself, but I think everything that is an initiative, if we break it down to the very simple principles, from a modeling perspective, what is a model? A model is trying to represent reality, but it's doing so given some historical situation, right? So again, I don't want to go into the technical things that, it's one representation of one reality. Every model is just one representation of one reality, and reality and can be infinite realities, right? So if we follow this adage, or if we subscribe to this notion, anything that doesn't necessarily agree with the reality of one model, with the one realization that the model is trying to follow, is trying to predict, if you wanted, will mean that there is an impact on that model, i.e., it will mean that there needs to be some supporting mechanisms, as I call them, to be able to help recalibrate the model, readjust the model, etc., etc.
And I suppose, what are thoughts? I mean, so you talked a bit about, the credit risk is very much around making predictions and then comparing those predictions against actuals, and then having the infrastructure to then compare if the actuals are right or not, which really sort of gives you a view around the models. I mean, what kind of infrastructure do we need to start thinking about? Because the problem is we don't have the actuals, right? So we had a lot of predictions, but we didn't have the actuals, right? And so what kind of infrastructure do we now need to think about when it's been moving so fast?
we might not have had the actuals, or we might have actually had some distorted actuals, as I called it. But this is not necessarily something new to the financial industry. I remember that this was the case with a lot of financial institutions when there was a cease on repossessions because of a court case. I can't remember now the name of the court case. I think Stephen might even remember it better than I do. But and then at that time, financial institutions didn't have any actuals, so they had models trying to predict repossessions, but they were comparing it against nothing. So financial institutions had to come up with some novel ways, be that a benchmark, be that something else, of trying to see how good the model was predicting given the absence of actuals.
I mean, and we're almost at time, but I mean, Michael or Stephen, any final last thoughts on that or other things just before we close?
No, I think you're right. We don't have a lot of actuals. We don't. I mean, going back to one of the earlier points, the macroeconomic forecasts that we've had and everyone's had over the last 12 months have varied so massively. And it sort of goes back to the question about the amount of provisions that were built up during 2020. The variation in those forecasts that different lenders would have seen is huge. And through time, they've varied massively as well. To be honest, there's a little bit of a patient waiting game here to see what the actuals are actually going to be, because the further we go into this, the more that people are taking actions to prevent the predictions from coming true.
Yeah.
Like going back to the furlough point, right? Unemployment was going to go up to X, so we're going to do furlough to make sure it doesn't go up to X. So the forecasts are now Y. Yeah. But does that just push it out into the future?
Yeah. And Stephen, just bring in the last word, I suppose.
I think and really that probably just looking at the unintended consequences. I mean, I think I'd like to say both Eleimon and Michael, I'm pretty in awe of the knowledge that these guys have got when it comes to their subject matter. So I'm not going to say that I'm out my depth, but yeah, it's just really interesting listening to the future of our industry and where data and modelling is going over the next few years. So I've found this a really super interesting session this morning.
Yeah, I mean, I'll definitely echo that. I mean, thanks everyone for joining. I mean, all three of you, it's been fantastic, and I think we've had some really great insights into just what the future of credit risk is going to be. From a lending technology point of view, it's been fabulous. So I think we're almost at time. I think for this session. I mean, please, for anyone else, please do join us at the next session, which Colin, I think it starts at 12:50, right? No, sorry, 11:55.
11:55. Thanks,
11:55. Yeah.
Here, spot on. Thank you. Really interesting. Thank you very much to our panel and Chris, obviously. I think an interesting point Eleimon made about the machine learning. I think that's a really interesting point. I've heard that before, and I think there's a lot of technology that's emerging and coming forward, and the machine learning one's a really interesting one about the biases and where that comes from. And we run the Credit and Collections Technology Awards, so we're always interested in what technology is coming out, but how it's used more and whether it's really got the best customer outcome at the heart of it. And introducing these kind of things, you've got to be so careful, haven't you? Especially in this new world. So really interesting, great insight from everybody. Thank you. So I'll end up by obviously thanking Michael, Stephen, and Eleimon for their time there, and Chris, of course, for chairing the session. We are going to break now until 5 to 12, where we'll be covering our next session in the irony of one of those areas we discussed, open banking. So I'd like to thank everybody who joined us. Thank APR Data for sponsoring that session as well. And we will hope to see you at a future session talking about this subject, credit risk, but also in one of our other sessions today. So thanks everybody. Thanks to our audience, and we'll hopefully see you all again soon. Thanks a lot, everybody. Cheers. Bye.
Thank you very much.
Bye.
Thank you.
Bye.